everyone. Welcome to Chapter 15, Part 2. In this particular video, we are going to focus on losses for taxable business entities. So let's get started. So starting with flow-through entities, when we think about those losses are generally available to offset the owner's personal income subject to restrictions. And those, sorry, I have something on my screen, guys. There we go. All right, subject to certain restrictions. And those restrictions are basis, at risk, passive activity, and then excess business losses. The ones that we will focus on the most for our particular class is basis and then the passive activity. So with basis, ways to think about what basis is how much of this entity are you responsible for? What is your stake in the game? So let me get my pen here. How much are you responsible for? So if we want to think about basis as a math problem, whenever we look at our basis, we have our starting point, which is our beginning basis. So beginning basis. Then we can add items that increase our basis, which is typically any income from the business. Then we can subtract anything that would lower our basis, so such as a loss or distribution. And then when we combine everything together, that gets us our ending basis. So now if we want to add some numbers to this. So let's say we have our business, and let's say it's January 1st, 2024. And our beginning basis, let's say, is $10,000. Let's say for 2024, we had income of $10,000. Our ending basis for 2024 becomes $20,000. Then we move on to the next year. So our ending basis at the end of 2024 becomes our beginning basis for 2025. So 1/1/25. Our beginning basis is $20,000. Let's say in 2025 we had a loss of 15,000. Then our ending basis would become $5,000. An important thing to know about basis is a loss cannot cause a basis to become a negative number. So the lowest you can go is 0. So let's revise our 2025 example. Or actually, we can just continue from the end of December. So if we keep going here, so 1/1/26. Our beginning basis is the $5,000. Let's say we had another loss, but it was only $7,000. Our ending basis for 2026 will become 0. Since that loss can't bring our basis down into a negative number. However, the excess loss, so 7 minus 5 is 2, the extra $2,000 loss, here I'll kind of write it across the bottom here, extra $2,000 loss can be carried forward. Right. For passive activity, switch my colors here. So passive activity typically generates a passive income or a passive loss. And how that happens is usually if you are in a limited partnership or a limited partner, your activity in the business is considered passive. And so when we think about passive activity and specifically passive losses, whoops, hold on, let me rewrite that, guys, sorry. Okay, let's try that again. So passive losses can only be deducted to the extent of passive income that is available. And additionally, any unused passive losses can be carried forward and used to offset passive income that is present in future years. All right, we're going to attempt to go to the next slide. We're going to see if it'll let me. All right. So now we can look at a couple of examples of losses. So in our first example here, our fact pattern says, assume that Nicole will organize CCS as a C corporation, and that in spite of her best efforts as CEO of the company, CCS reports a tax loss of $50,000 in its first year of operations, year one. Also, recall Nicole's marginal tax rate is 35%, and assume she will have ordinary taxable income of $200,000 from her husband's salary in year one. How much tax will CCS pay in year one, and how much tax will Nicole and her husband pay on the $200,000 of other taxable income if CCS is organized as a tax corporation, as a C corporation? My brain was working faster than I was speaking. Okay. So what I'm going to do, I'm just going to highlight our questions so that way we know what our final questions are that we're supposed to be answering. So how much tax will CCS pay in year one? And then how much tax will Nicole and her husband pay on the $200,000 of other taxable income? And it's important to note here in this particular example, CCS is organized as a C corporation. So then let's organize some information here. So we have the corporation, specifically the C corporation, and then Nicole and her husband. So under the C corporation, CCS reports a tax loss of $50,000. Since that corporation has a loss, so $50,000 loss, the amount of tax they will pay is zero. For Nicole and her husband, their taxable income is $200,000. And they gave us in the problem that their tax rate is 35%. So then as we can recall back from chapter 1, the way to calculate a tax is your tax base times your tax rate. So then their tax paid, let me see if I can do this math in my head. Maybe not. I'm going to get a calculator real quick. let's see, 200,000 times 35%. That gets us 70,000 in tax paid. All right, continuing our example problem. Let's suppose that CCS instead is organized as an S corporation. And Nicole's basis in CCS before the year one loss is $100,000. I'm going to get a highlighter so we can highlight our questions. How much tax, whoops, let me actually highlight that. How much tax will CCS pay in year one? And how much tax will Nicole and her husband pay on the $200,000 of other taxable income? So I'm going to make a note up at the top because it doesn't list the tax rate here. But from the previous example, there, whoops, don't know how I got to the eraser. Okay. Their tax rate was 35%. So CCS this time is organized as an S corporation. And we have Nicole and her husband again. So the S corporation it had a $50,000 loss. And the tax that it will pay this time is 0. And the reason why is a little different from the C corporation reason. So the reason why the tax paid is 0 for an S corporation is because an S corporation is considered a flow-through entity. And flow-through entities are not the entities actually paying the tax. So what we'll see in a second is this $50,000 loss is going to flow through to Nicole and her husband. And that will have an impact on the final amount of tax that they will pay. But for the S corporation purposes, its tax paid is 0. So then if we go to Nicole and her husband, they had, or I guess have, 200,000 of taxable income currently. So that was from the husband's salary. Then when this $50,000 loss flows through, so this arrows are flowing through from the S corporation to Nicole, the owner, that $50,000 loss, so that 50,000 S corp loss can offset their taxable income. So now, here I'm going to highlight these two just so you can see the movement. So $50,000 loss. So now their taxable income is only $150,000. So we'll say new taxable income. Then if we multiply by their 35% tax rate, their new tax that they will pay, well, I'm pulling up a calculator so I can do some math. So 150,000 times 35%. Their new tax is 52,500. Now, it doesn't specifically ask about it in here, but something to think about is in the fact pattern, they mention that Nicole's basis before the loss is $100,000. A possible question that could be posed with a fact pattern like this is what would Nicole's new basis be after year one? So what we could do to calculate that, and I'll do it in blue so it matches the blue highlight. So we know her beginning basis was $100,000. Then we have the loss of $50,000. Then that would make her ending basis $50,000. And then that will become, assuming this was the only activity that happened, then that ending basis of $50,000 will become her beginning basis for year two. All right, so in continuing our discussion about losses, C Corp losses have very special and specific rules for losses. And they're typically referred to as like the NOL rules. So NOL stands for net operating loss. And what makes the rules very specific is because it's related to the dates in which those losses are occurred or whenever they were incurred. So whenever we have an NOL problem and we're trying to think about how to apply it to various tax years, we have to pay very close attention to the dates. And so I'll go through and highlight the dates as we talk about all the different pieces. So, first set of NOLs. C corporations with a NOL carryover that occurred in 2017 or earlier. What you can do with that NOL is it can be carried back 2 years or carried forward up to 20 years. And then whichever direction you go, that NOL can offset up to 100% of the taxable income in those years. I'm going to highlight 100%, and you'll see why in a second. If a C corporation has an NOL that was incurred in 2018, 19, or 20, you can carry it back 5 years, or you can carry it over indefinitely. And whenever you carry it, either back or forward, you can offset up to 100% of the taxable income if carried back or used in tax years 2018, 2019, and 2020. Then the third set, so C corporations with NOLs incurred in years 2018, 2019, 2020, and later. So I'm even going to highlight the and after piece, because this distinguishes it from the second set. So NOLs generated in tax years 2018, 2019, and 2020 that are not completely used in 2018 through 2020 can offset up to 80% of taxable income remaining after deducting the NOLs from tax years beginning before 2018. Additionally, these more recent NOLs that can occur, they can be carried forward indefinitely. So they do not expire. But then the caveat with that now is there is no carryback allowed, so you can only go forward. Whenever we look at NOLs, if we have multiple losses, they are treated in a first in, first out method. So that way we know the order to apply them. And then additionally, these losses are not available to offset the owner's income, which makes sense because a C Corp is not a flow-through entity. So those losses aren't flowing directly to the owner's tax returns. That C Corp is its own tax-paying entity. So I know that was a lot of rules. For the NOLs, there's a lot of dates to keep track of, and just kind of a lot of words and language to think about in general. That is a fun thing about tax. Lots of very wordy and specific rules. So then what we'll do on the next slide is we will walk through an example of a net operating loss, a very simple example, and practice applying these rules based on those dates. Alrighty, so we have an example of an NOL here. And whenever we read the problem, it's going to be the exact same information. So the taxable year, the amount of the NOL, the amount of taxable income before the operations. What we'll see though, and I've already kind of bolded the text, but I'll even highlighted it too. The big piece that we want to pay attention to is the years, because those years will dictate how we will go through the calculations. So let's get started. In the first one, it says, in 2022, BYC Corporation, a C corporation, had an NOL carryover from 2017. So I'm going to highlight our year. So 2017 in the amount of $40,000. I'm going to highlight our question so we know what we need to answer. How much? Whoops. Sorry, guys. Thought I was on my highlighter. How much tax will BYC pay for 2022 if it reports taxable income from operations of $35,000 before its NOL deduction? So in our problem, our NOL carryover is from 2017. And so if we think back to our NOL rules, this one should be able to either carry it back 2 years or carry it forward up to 20 years. And we can offset 100% of the taxable income. So I'll kind of add those notes out here so we have them. So we can either carry back 2 years or forward 20 years. And then the big key is we can offset 100%. So then if we look at the facts from our problem, we have our taxable income of $35,000 and an NOL of 40. So since we are allowed to offset 100% of our taxable income, 40,000 is greater than 35,000. So then we are allowed to subtract 35,000 of our NOL carry forward. And that means our taxable income is now $0. And then since our taxable income is 0, we answer a question, how much tax will be paid? The tax paid will be $0. Another possible question to think about. How much of our NOL is left over that could potentially be carried forward into 2023? So our starting NOL is $40,000. We used in 2023, or 2022, used 2022. We used 35,000. So then the remaining that we can use is $5,000 for 2023, potentially. So NOL for 2023. Now let's look at the next one. So same exact information as above, but now our NOL year is 2018. And the question we still want to answer is how much tax will BYC pay for 2022? So for this one, since we have an NOL from 2018 and it has still carried over into 2022, so meaning we didn't fully use it in 2018, 2019, or 2020. Our NOL rules now are they can be carried forward indefinitely. All right, I am on my pen. Okay. So they can be carried forward indefinitely. And no carry back. And then the big thing to note here is with these ones, we can only offset 80% of our taxable income. So our taxable income before the NOL deduction is currently $35,000. If we multiply that by 80%, that gives us $28,000 for the NOL that we can deduct. So then $35,000 minus $28,000 of NOL carry forward equals, oops. Sorry, it's a really funky looking 7, but it's $7,000 of taxable income. Then to calculate the tax, because that's ultimately the question we want to answer, tax is our tax base times our tax rate. So we know our tax base. Don't know how I keep going in my eraser. Tax base is $7,000. And then the tax rate for a C corporation is 21%. And then that gives us the amount of tax paid of $1,470. So tax paid. And I'll actually put that over here too. So how much tax will they pay? $1,470. And then just another piece to think about since we calculated up in the first problem. How much of the NOL do we have left over? So I'm going to kind of borrow the space over here. So our starting NOL was $40,000. We used $28,000. And then the remaining NOL is 12K. 12K. And that $12,000 can be carried forward into 2023 and every period after that until it is used. All right. Thanks for watching, guys. Good luck studying.